Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Quick tax fact. Some creative companies can receive tax relief even when they're making a loss. The UK operates a set of creative sector tax reliefs designed to support cultural and creative production. These reliefs sit within corporation tax and are available to companies involved in producing qualifying creative works. Depending on the sector and the rules in force, relief can take the form of additional tax deductions or a payable tax credit where losses arise. The reliefs are detailed and sector-specific, but the common aim is to support the cost of producing culturally qualifying content. The creative sector reliefs apply to companies producing films, television programs including high-end TV, animation and children's TV, video games, theatrical productions, orchestral productions, and museum and gallery exhibition productions. Each sector has its own qualifying conditions, but all operate under a shared legislative framework within corporation tax. A fundamental rule of the creative sector reliefs is that each qualifying production is treated as a separate trade for tax purposes. This means income and expenditure are calculated production by production. Profits or losses from one production do not automatically offset others, and results are kept separate from any non-creative activities of the company. This separation is central to how relief is calculated and claimed. From 1st January 2024, the tax relief for films, qualifying television productions, and video games moved to a system of above-the-line taxable expenditure credits. These are AVEC, the audio-visual expenditure credit for films and qualifying TV, and VGEC, the video games expenditure credit. These credits are taxable and appear above the tax line in the accounts. As at September 2025, films, high-end TV, and video games qualify for a 34% credit. Animated films, animated TV, and children's TV qualify for a 39% credit. Because the credit itself is taxable, the net benefit depends on the corporation tax rate. At a 25% corporation tax rate, a 34% credit gives a net benefit of 25.5%, and a 39% credit gives a net benefit of 29.25%. Additional enhancements apply. Visual effects costs may qualify for an uplifted rate from April 2025. Certified low-budget films starting principal photography on or after 1st of April 2024 may qualify for a 53% credit, producing a net benefit of 39.75%. All rates are subject to change and must be date-checked. Before 2024, creative companies could claim an additional corporation tax deduction or surrender losses for a payable tax credit. These older reliefs still apply to new productions until the 31st of March 2025 and to continuing productions until the 31st of March 2027. From April 2027, the old deduction-based regimes will cease entirely. Theatre, orchestra, and museum and gallery exhibition reliefs remain under the older deduction and credit structure. Companies may claim additional deductions or surrender losses for a payable credit. Each relief has its own qualifying conditions, including cultural tests, production activity requirements, and sector-specific evidence obligations. Under the new AVEC and VGEC regimes, relief is linked to qualifying UK expenditure, replacing the earlier focus on European expenditure. Costs cannot be claimed twice. Expenditure included in a creative sector claim cannot also be claimed under R&D relief, even if it would otherwise qualify. This interaction is particularly important where software development or technical innovation overlaps with creative activity. Creative sector reliefs are claimed through the corporation tax return. From 1st of April 2024, claims must be supported by an online additional information form and detailed supporting evidence. Evidence typically includes details of the production, a calculation of the relief or credit, a breakdown of qualifying core expenditure, and certification where required, such as BFI certificates. The additional information regime was expanded in April 2025 and is mandatory. Time limits for making, amending, or withdrawing claims depend on the accounting period and whether it began before or after 1st April 2024. Longer time limits apply for more recent periods, but claims still require early planning. Payable credits under AVEC and VGEC are restricted to companies that are going concerns. HMRC also has extended powers to recover overpaid creative credits, even where claims were made in good faith. In summary, creative sector reliefs are generous but complex. Productions are taxed separately. The regime changed significantly from 2024. Evidence and certification are critical, and planning and accuracy matter. This brings us back to the fact we opened with. Creative sector tax reliefs are designed to support production, not profitability. That is why companies can still receive relief, even when they make losses, provided the production qualifies and the evidence is robust. I asked if my film qualified for tax relief. They said, only if the evidence is better than the script.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.